Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scout, and jumping into the charts on this September 13th. The long-awaited CPI. I think this was one where many analysts were expecting a bullish outcome, inflation to soften, and this is why we block out the media, we listen to the charts, and we trust interconnected market analysis. So what transpired today? A bloodbath on Wall Street, and were we prepared for this here at Trading Capital? Yes, we absolutely were and are, and certainly our accounts have hit now a new all-time high yet again during this year of 2022, where stocks and investment portfolios have been massacred. So congratulations. We only covered one of our short trades for a winner. I did cover a day trade loss today. But nonetheless, all of the profits that we made today were insulated that day trade loss, and all the profits that we've made this year have also insulated that day trade loss. So many of you may not even have taken the day trade short with me, but nonetheless on ICE, I wanted to get out of it. But clearly technical damage done on the charts here on the S&P. A magnificent sell-off on Wall Street. The S&P is down 4.35%. Now, this type of sell-off, we were saying that it was very similar to this previous sell-off over here, where you had your massive sell-off, you had your 3-day bounce here, and then the selling continued. That's kind of what it looks to be transpiring here again, where you had your massive rally, sell-off, 3-day rally, which we had a 4-day rally right into resistance. You can see this beautiful, let me just draw that line a little thicker. You can see that beautiful resistance that was a previous gap fill level, previous support bounce before slicing through to your impulse move breakdown. So naturally you retrace to the level that you broke down from. It also happened to be your short-term moving average. And look at that sell-off, gap down, and then wait till I flip to the intraday selling to show you how powerful and how planned this type of selling was. This type of selling was all institutional base. Today we clocked in at over 120 million volume. The volume average for the year is around 73.4 million, so an extreme average in volume. It's good to see that the September volume flows are picking up, and that's what we've been waiting for. That's what we were prepping everyone in our member service for since this light volume flowed up. And don't get me wrong, we caught this magnificent rally. Sure, did we get out at the exact top? No. Did we get out at the exact bottom? No. But we banked our winners. We went short. We started accumulating more shorts. And now look, we're prepared for this potential likely next down leg. And based off of what transpired today with a CPI reading of 8.3%, people should have known, certainly we, based off of all the data that we analyze and have been contributing into these daily analysis videos for, this whole year, we have been prepping people that this market is likely to see its next leg down, and that's certainly what looks to be coming to fruition. On the back of the CPI coming in hotter than expected at 8.3 instead of a market consensus of 8.1 or 8.05. So with that being a little bit hotter than expected and with core pieces of the CPI not coming down, this leads investors to concluding that the Fed is not pivoting. And we already knew this. We didn't have to have a crazy CPI print of this, but the market always seems to want to move price action in a new direction based off of some market fundamental news event. So we were ready for this resistance, and the beautiful thing about this pattern that has transpired now, a couple things you have to keep in mind: that the pattern broke out, you were looking for confirmation. After you fail confirmation and head back into that original trend, this is what's called a failed breakout. Failed breakouts often lead to the biggest moves in the direction that it fails. So the breakout was to the upside, it failed. Now it's showing that price action has to significantly drop to basically correct the market from this situation where it wasn't truly ready to break out to the upside. Now, in terms of downside, you do have some support levels over here. So your first big support comes in over here around this 391 mark. And then you also have some support at the low range of this gap. So it will most likely coincide with the low range of this channel around 388. You can see you have your pivot to your pivot to your pivot. There should be somewhat of a technical bounce The bounce may take you, something to where you bounce off of this level, maybe back up to this trend line, this downsloping trend line, and then I presumably think the next down leg starts sooner rather than later. But overall, tremendous amount of weakness now in the markets, and now you do have that fundamental news drop that the media can start to drive and spook out the retail investors. And the interesting thing about this sell-off, if we look intraday, obviously you had this initial reaction to the CPI, a massive dump within 2 minutes. It was instant. I was watching it as the CPI came out, boom, spiders fell. And then the selling just started to commence all day. There were very few opportunities to day trade. We did capture one in the day trade room today, but it was earlier on. And then you did have this little bit of a lull afternoon spell where the volume lightened up. But this was kind of the bull trap where they stopped the selling. You were at support over here. And mind you, this was a key support level over here, which we cracked, which is why I knew we were going to go a lot lower. As soon as we sliced through this gap fill, like a knife through butter, and we didn't even get a technical retrace back to the breakdown zone, I knew we were going to be, or I didn't know for sure, but the probabilities did dictate that we were going to see a lot more downside. And honestly, the fact that we sliced through this support zone over here with a small little bounce, beautiful bear flag curl up, tricking investors to make it think that the market's going to go up, and then this is all institutional selling. When you have a tight range like this, where there's really not even an opportunity to day trade or catch a little bit of a bounce, this is all algorithmic selling, institutional, hedge fund. This is big boy selling, where this is designed to trap in traders or investors that think they're going to pick the bottom, where it's just too much selling pressure. Even the buying pressure couldn't even mimic or create an intraday bounce. Now you have formed a little bit of a bear flag here as well, but naturally you are oversold. Potentially we could see a little bit of a flush down to these daily support levels, which is what I think is likely to happen before we see a bounce. We have to remember we had 4 up days over here. Now we've had one massive down day, which is negated 1, 2, 3 days of price action. So that is the power of how fast the downside comes. This is why I'm sometimes even a little bit too early at taking profit on longs, because the downside is ferocious, and I know that. When I see the downside occurring, it's just tremendous, the sheer power and panic. And this wasn't even really panic selling, When you have panic selling, it's like this, straight down. But the fact that we had a little bit of selling pressure and then a little bit of a bounce and then more selling pressure, this is strategic selling that occurred. It's not a panic dump. If we saw the full move from this high to this low, all the way down from this high to this low as one straight candle, that is panic selling. So that is just buy everything and reassess later. So naturally the spiders, I do think there's more downside. If we flip to the QQQ, my chart might be a little bit messy. Let me just start over with the QQQ. If we look at the QQQ, also technical damage is done. You're back at these lower levels here. The question is though, at the end of this week, where are we going to be closing? Are we going to be making a new low, a new weekly low? If we flip on where we have a weekly low, currently at this level right now is the lowest weekly level in 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. So are we going to make a new 9-week low if we close at these lows by the end of Friday? That's kind of the big telltale sign for this market. If we make a new weekly low, from this whole move, that shows you the likely direction that the market is going to be heading in. So obviously with options X Friday, we could still see a bounce. Don't get me wrong, these markets have not technically broken this support level, although many stocks did today, individual stocks. The markets still are at support, which does favor somewhat of a technical bounce. But if you had to incorporate all the other factors like the DXY, the dollar, we were prepping everybody for this dollar move. We were discussing that you've now had 3 down days yesterday in a row with the potential you had 4 down days in a row. And then today you actually opened up, made a new lower low. And the significance of making that new lower low is you made technically 5 days of lower lows. And then look at this powerful move. It was up over 2% in the currency market. So when you factor in that the US dollar market is the deepest, most liquid market in the world, therefore it requires the most amount of liquidity to move it. When you have the dollar moving 2%, that means so many people were seeking US dollars. You had to essentially, I think, required $8 trillion in dollar demand today, roughly $160 trillion global market. dollar market, and roughly to move it 2%, I think it's around 8 trillion. So a massive amount of liquidity that was needed to move this dollar. But when you factor in you have a bullish engulfing candle, but you've engulfed the last 2 and 3 days of price action in one fell swoop, that is truly impeccable. And the interesting thing I want to bring to everybody's attention, so the last time we had this powerful dollar rally where you closed was the COVID low. This is your COVID melt up. It was the collapse in the stock market. So imagine that. The last time we saw a 2% swing intraday on the daily chart was that COVID low. Okay, doesn't mean the low is in the market. This means that we could just be getting started. And then we also saw a major rally in the dollar in 2018 over here, where Powell was basically aggressively tightening. And then you also saw it over here, 2018. So it's very rare to see these type of moves in the dollar, but you do have to pay attention. Now, on a long-term basis, why I think the markets have more downside is because simply this powerful move in the dollar means that the trend is likely to continue up. And this, as long as we're trading above this range, this 104, it's in tighten mode. So now we're almost at the top of this tightening range that we've seen. And it's likely that we could head even higher in the dollar, which would likely send the markets even lower. Just glancing at oil was the strong sector of the day. And when I mean strong, it was only down by 0.5%. So clearly still hugging this parallel channel. I still want to see it potentially float up to the top end of this channel before I could execute a short. We may get that. Now that the markets have seen the weakness in tech and amongst a variety of other stocks, people might flood into commodities, which could give it that initial surge up, which could be a beautiful shorting opportunity. Natural gas was actually positive on the day. Very flat, but positive nonetheless. So energy was the bright spot, so to speak. But again, the question is, are we getting that head and shoulders formation that could be potentially forming? I want to see us get up to this 865, 870 level before I execute a short on natural gas. But it could be one of those sectors that, since it was a bright spot, what you do is you have people that trade relative strength. In down days like this, especially broad market sell-offs, when the markets sell and everything is being sold, there's relative strength traders out there that will make notes of all the stocks that basically held up in a down market. And being the fact that the natural gas chart held up significantly well, that is certainly could be an asset class where people start parking money in tomorrow, as there is a lot more cash now on the sideline after today's sell-off. So interesting to note what transpired today. Well, this is a really critical thing because we were watching this yesterday. We telegraphed it. We said one of the reasons why we thought the markets were going to take a hawkish CPI print and most likely sell off is the bond market. We were watching the bond market. You almost had a technical confirmation. It was about a penny away from technically confirming a breakout. And today we technically confirmed a breakout on the US 2-year yield. So the interesting thing that the market was kind of hoping that the Fed was only going to, maybe raise rates by 0.5 and then pivot, come October, November, December, maybe one more rate hike of 0.25. But that's not what the bond market was showing. The stock market had a mind of its own when the mass liquidity in the markets come from the credit bond market. So clearly the signals that we were watching were correct this time around. And this is why it's so important to watch interest rates and yields, because they will often guide you where the largest inflows of money are heading. The largest inflows of money do not head in and out of the stock market. They head in and out of the credit and fixed income markets, where that's certainly where the smart money is, and a massive breakout. Now, what this breakout in interest rate tells us is that the federal fund rate has to still raise rates even more based off of the hawkishness of the bond market. So the federal fund rate now with a likely 0.75% hike, which would take us to 3.25%, that still suggests that even after a 0.75% hike, based off of where the US 2-year yield is right now, the Fed still has to hike an additional 0.5% after that. So that's what the markets are not liking, and that's why we're seeing the sell-off, and that's why asset valuations are still going to be compressed, because that market, the stock market, was expecting maybe one more hike of 0.25% after this next hike here in about a week's time. And that certainly has now been flopped on its head because CPI has now come in higher. And this is why inflation is going to be a little bit of a, I wanted to swear there, but a little bit of a problem, more of a systemic problem is we're starting to see it even with the massive decline in commodity prices. You know, we take a look at oil, it's down from its highs. We take a look at copper. Copper is significantly down from its highs. We take a look at lumber. So lumber is significantly down from its highs. You know, even with the collapses in commodity prices, we have yet to see inflation truly peak and start making a what we call a confirmed downtrend. So imagine if oil starts to roar back once that SPR release starts to wear off and investors start to price in the fact that, okay, now the reserve is down to pretty much bare minimums. And I think we have about 400 million barrels, about 2 more strategic petroleum release plans available. If the market started pricing in that where the US needs to restock maybe for a war, oil could spike tremendously, which would exacerbate the effects of inflation on the overall economy. And honestly, that would send inflation in all metrics up much higher. And then what does the Fed do if rates are already this high? I mean, if we flip back to the US 10-year yield, rates pretty much hit a double top today, just shy. So I'm hoping we get one more push up, but I did add to the UBT play today. You can see that we've come nicely off the lows on UBT where we've added. And one of the reasons I added there, if we look at the 20-year yield, so if we take a look at the 20-year yield, you did pretty much hit this double top. Didn't quite take out this topping tail, but this is a nasty reversal signal on yields. One that you're still technically trading in and is resistance, but I had to add up at these levels right into a double top, and we are getting a slight pullback in the long duration treasury. So that is good to see that our plays are working out left, right, and center. We did cover Amgen. We sold our SE today for a beautiful trade right at the pre-market before it even collapsed even more. The writing was on the wall. I mean, if we simply look at, you know, here we have Microsoft on the left, and I'm just doing 3 split screen mode. We have Microsoft, we have Apple, we have Meta. So Microsoft is at technical support. You have a gap fill right over here, which may be a potential bounce opportunity intraday action. Apple is still holding above these wick lows, but is also very close to this gap fill. You have to think Apple's flowing there. The crazy thing about Apple's move is it was up so much, over 100 billion flowed into Apple yesterday, and all of that 100 billion and then plus about another 60 billion has been wiped out in one fell swoop. So that is amazing. I mean, when you simply look at 1, 2, 3, the last 3 days in Apple have been negated in one fell swoop. You don't see that every day where Apple, a multi-trillion dollar company, is down 5.87%. And then look at Meta, a new low of the year once again. So clearly the relative weakness in Meta is continuing. Obviously, tech is under pressure with the yields skyrocketing and breaking out to the upside. And this is why we are net short the market. It is great to see your trades and the analysis, the intermarket analysis working out. And the beautiful thing is that I've prepped you all. If anyone was surprised and if anybody didn't make money in this turn, the down leg in the market, then I'm sorry, but you have completely yourself to blame. I even have clients that were doubting me, you know, a long-term 7-year-old investor who has more experience in the markets, more investing experience. Mind you, it's experience that's been under the artificial interest rate liquidity programs and quantitative easing. So one can argue it's very minimal QT experience, but nonetheless, investors are getting killed. And now I have clients running to me to basically say, you were right. You know, let's get our investments out. Can you trade some of our capital? And mind you, I'm full now. I cannot actively manage more investment portfolios. And that's how it usually works, is people really only start being reactive when the knife is fell and the markets are falling. So I even have a best friend who inherited a bunch of money and basically put it with the banks. And I said, listen, buddy, don't put it there. Don't put it there. Move to cash right now. If you don't know how to short and day trade, move to cash. And he missed out on the opportunity of selling. He's holding the bag now. His investment is going down. And this is a best friend. I wasn't charging him. I was giving him free advice. I spent hours consulting. But some people either take the information and put it to work, and some people don't. And that's the key difference between if you're going to make money, if you're just going to preserve your wealth, or if you're going to lose money. And frankly, I would take the first option. I'd rather make money. So congrats again, new high on our accounts. Obviously my expectations is more downside to continue. Let's just flip back to the SPY. More downside to continue because we've had that failed breakout. But obviously I do think we could see a bounce in some names. We bought some Canopy. Canopy is right at support. We've day traded Canopy at this level basically a day ago, netted 7.7%. So I think Canopy is actually still bullishly holding this support level where you're at this downsloping channel line over here, you're at this upsloping play. And then one of the reasons I think Canopy can actually be a little bit of a market divergence play is that even if the markets fall like the S&P, I think Canopy can move just based off of midterm expectations of potentially legalizing cannabis to sway voters as they vote for the midterm election. We also bought Intel. So mind you, considering we still have a bearish outlook, the fact that Intel is now collapsed down to new lows on the year is just mouth-watering to me. And not only has Intel now filled a key couple technical gaps which you pierced through, you also got a retrace, a 618 retrace of this full down move, you know, the COVID lows to the highs, and you're into major technical support. So this is multi-year consolidation. You have 2014 pivots. So imagine if you're an investor and you bought in 2014 Intel. You've basically now break even a whole 8 years later. And if you bought in over here 2016 all the way to 2017, we're talking about over a year, you're basically break even. So massive support level here on a weekly time frame. You have a key fib level. You're in an oversold condition 4 down weeks in a row. I wanted to look at the RSI just to see where we are on a weekly chart. We've now entered an oversold category. Basically for the last, since the beginning of September, we're now in an oversold category. When we look at where these oversold categories were last hit, we're talking about the 2007-2008 global GFC crisis. We hit an RSI down here of 25.39. We're almost trading at that level. I don't like to use RSIs a lot, but I only like to use them to give you a massive oversold condition comparison to previous historical crashes. Even in the dot-com bubble, we did not have an RSI as low as we do now in the dot-com crash. So it's truly amazing that we're starting to accumulate these quality companies. Yes, it's a semiconductor computer play, so overall it could see more downside if the semis do, but this is still a quality company. It does have a small dividend, and the nice thing is that you do have some support here. If we flip on the volume chart, this weekly reversal signal here shows that this technically still is support in the bottom. You need a weekly close and confirmation below to negate that. But there's a lot of buyers here just waiting at this level. And the fact that we're lower, we're at a key support level, multi-year support level, this is a salivating opportunity just for me to potentially play a bounce trade. Now, could Intel go lower? Yes, it could. But if we flip to the larger time frame, we'll keep the RSI on. You can see on a monthly time frame, Intel as a company has never been this oversold on a monthly chart RSI ever in its history. So when you see signals like that, plus you're accompanying it with support zones, fib zones, oversold conditions, moving average support, market support, you have a potential bounce play that you have to play. And we're not looking for, a bounce all the way back to this line. We're looking for a 10-15% bounce, maybe back up to this 33 level, which could easily happen. So could Intel go a little bit lower? It could. I have another big add level here around 28.13, and then obviously on this monthly 200-day moving average. Now there is a chance that it could flush down to this monthly 200-day average, but that's only about 4% away. I'll have no more problem accumulating yet again, inching in, increasing our exposure to potentially and inevitably waiting for that bounce. A company like Intel should have a bounce and most likely will have a bounce, considering it's at oversold levels that we have never seen in its company history. Is certainly should be screaming to you as a technical analyst and trader. And that's the signal that I'm getting, is that it's buying. The charts are telling me buying, at least starting to accumulate. If it goes lower, we buy a little bit more, and inevitably wait for that bounce. But overall, a massive day down. Let's take a look at the mega cap list here. Apple, 5.8. Microsoft down. Amazon, just massive sells. Look at NVIDIA. Massive dumps on NVIDIA. Nvidia is making a new low. I guess it's pretty convenient that Nancy Pelosi did sell all of her Nvidia, you know, somewhere up here. Now look where we are. So it's crazy that these semiconductors are breaking critical levels, but they are also starting to come into massive supports. Let's just remove all this and see if we can find a key support level on Nvidia. I know Nvidia is a hot commodity. So again, you're into this massive range of support. I have to naturally assume that at some point we're going to come down here to fill this gap. So I think that 115 is going to be a massive, massive level to play. And that might be where we get that big multi-week bounce off of that level. So that's going to be a massive level. I do think now that we've triggering this bear flag, we could see that level sooner rather than later, maybe over the next 1 to 2 weeks. If the markets really start to panic and see this downside trend continue, then we certainly could see some massive, massive pressure. So overall, amazing job. So much to analyze here with new patterns forming. But again, congrats if you've been trading along with us, because we are on our way to making more than 50% return on investment this year by trading the charts, trusting the charts, blocking out the bullishness, blocking out the news, blocking out the bearishness, and just overall looking at what the charts are telling us. And that's certainly how we were prepared. And we're going to potentially bank tons of profits in the coming weeks as the markets are likely to resume their downtrend. So congrats everybody. Please give this video a big like down below. I've been trying to telegraph this, and if you've been following our trade alerts and position management, you would be profiting along with us. So again, congratulations.